Have you ever noticed how your brain tricks you at the worst possible moment? You see a perfect setup, but instead of following your plan, you convince yourself the market will do something else. Or you hold on to a losing trade, telling yourself it will come back. We call this bad luck or lack of discipline, but in reality, it's something deeper. It's your own mind, full of hidden biases, quietly pushing you to make the wrong decision. Welcome to Module 3 of the Trading Psychology Course here on the ComLucro channel. In this lesson, we're going to uncover the invisible forces that make traders sabotage themselves again and again. Cognitive biases. These biases are not random mistakes. They're patterns of self-deception built into the human brain. And if you don't recognize them, they will quietly drain your account, no matter how good your strategy is. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let's start with one of the most dangerous traps for traders: confirmation bias. Confirmation bias is when you only pay attention to information that agrees with your existing opinion and ignore everything else. In trading, this might look like seeing a clear bearish signal on the chart, but because you already decided the market must go up, you dismiss the evidence. You search Twitter or news headlines for any reason that supports your bullish view, while rejecting anything that contradicts it. This bias feels comfortable because it protects your ego. You don't have to admit you might be wrong, but it's deadly because the market doesn't care about your opinion. It only responds to price and probabilities. And that stubbornness, the refusal to admit we're wrong, is exactly what professional traders warn about. Listen to how Phil Goedicke puts it.
Now let's talk about being stubborn for a minute. Why is it that we refuse to cut losses? Is it that sometimes we refuse to be wrong? Or has the research we've done on any particular stock made us so overly biased that we think the market is wrong and we are right? Or did we possibly take on too much size overnight on a low float stock that's opened dramatically against us? You know, there's numerous reasons we take losses in the market. You know, I think at the end of the day, our losses are they're basically our fault. I mean, sure, there can be unexpected news or events, but at the end of the day, I think it's our stubbornness that leads to some of our biggest losses.
Exactly. Confirmation bias makes you stubborn. It convinces you the market is wrong and you are right. And as Phil explains, that refusal to admit you might be wrong is often what turns a small mistake into a big, painful loss. Now let's look at another classic trap: overconfidence bias. Overconfidence shows up when you start believing you're smarter than the market. Maybe you've had a few winning trades in a row, and suddenly you feel unstoppable. You increase your position size, ignore your stop loss, or break your own rules because you just know you're right. This is dangerous because markets are designed to humble traders. A small streak of wins can make you feel like a genius, but one bad trade with oversized risk can wipe out all those gains in minutes. Think about this. How many times have you increased your trade size after a big win, only to give it all back on the very next trade? That wasn't strategy. That was overconfidence taking the wheel. Psychologists Daniel Kahneman and Amos Tversky showed that humans consistently overestimate their own skills and underestimate risk. In trading, this bias becomes even stronger because money is on the line and emotions run high. And here's the science behind it. Trading coach David Paul explains how the chemistry of your own body can trick you into feeling invincible after a winning streak.
If you've got 100,000 rand in your account, you should not risk any more than 1 to 2% of that in any one trade. And that will keep you alive. But there's a big problem, because we have runs of good ones and runs of bad ones. Now, between your ears, there's a thing called the pituitary gland. And that pituitary gland pumps out muti, that pumps out all sorts of hormones into your bloodstream. And those hormones are actually responsible for every emotional state that you have. When you have one good trade, two good trades, 3 good trades, the pituitary gland is hard at work, okay? And it's pumping this muti into your bloodstream. And you change completely. What happens is that after a series of winning trades, we become euphoric. And if you look in the Oxford Dictionary, the definition of euphoria is invincible. So just be careful about euphoria.
That's the danger. That feeling of being invincible is not reality. It's just chemistry. Overconfidence isn't proof that you're in control. It's a sign that your biology is pushing you to take risks you wouldn't normally take. And if you let that feeling run your trading, the market will eventually teach you a painful lesson. Another bias that destroys traders is herd mentality. Herd mentality means you follow the crowd simply because everyone else is doing it. In trading, this usually happens when you see a sudden wave of hype. Social media, news headlines, chat rooms, everyone is talking about the same stock, coin, or setup. Your brain tells you, if so many people are in, it must be right. So you jump in too, not because of your system, but because you're afraid of being left behind. This is how bubbles are created. Remember the dot-com boom, the meme stock frenzy, or crypto surges? Thousands of traders bought, not because of logic, but because the herd was moving. And when the herd reversed, accounts were destroyed. The painful truth is that the crowd is usually late. By the time everyone is talking about it, smart money is often already exiting. And that's why professionals warn about blindly following the news and the crowd. Here's how Larry Williams explains it.
You really have to be careful what you read. I don't read the Wall Street Journal. First of all, a lot of times they report stories in the Wall Street Journal that are kind of a jinx, how good the company looks and the company falls apart. What I trade is what's right in front of me in my charts and the data that I look at. There are just so many stories, whether it's the Wall Street Journal or Forbes or any of the media, that get us off track of being a real long-term investor or even a short-term trader. So be careful what you read. There's a lot of stories out there that are, well, they're written for a purpose to get people like you and me to buy when we should be selling.
That's the point. Herd mentality feeds on headlines and hype. If you trade based on what everyone is saying, you're probably late. As Larry shows, the real edge comes from ignoring the noise and trusting your own charts and data. Now let's talk about FOMO, the fear of missing out. FOMO is that powerful urge to jump into a trade simply because you see the market moving without you. You tell yourself, if I don't get in now, I'll miss the whole move. So you chase the price, usually entering too late, right before the pullback. This bias is everywhere in modern trading. Social media amplifies it. You see screenshots of profits, traders bragging about catching huge moves, and your brain starts screaming, I need to be part of that. The problem is that FOMO rarely lines up with a solid trading plan. It's an emotional reaction to opportunities slipping away. And once you're in the trade, you often realize you broke your rules and regret it. As Tom Hugard, author of Best Loser Wins, points out, the market punishes impulse. The traders who succeed are not the ones who catch every move, but the ones who can sit still and wait for their edge. FOMO feels like urgency, but it's really impatience disguised as opportunity. And the only real cure for FOMO is learning to stay fully present, right here and now, instead of projecting into the past or the future. As David Paul explains,
I think the ability, and you've got to work at it, to be totally and utterly present as the market is moving up and down. I think that it becomes more difficult if you're a short-term trader. There, your present moment could be a 5-minute chart, and I work very hard at being present to stay in this moment, not to look at the past moment or the next moment, but to ground myself in this moment. And people keep asking me, well, why do you do these courses if you're making so much money in the market? Okay, and the real answer, of course, is that sometimes when I'm on a stage speaking to a group of people that are positive, that I feel incredibly present. And when you're in the present moment, it's a very sexy place to be. This is a tip for all the short-term traders out there. If you're watching the clock, you're not in the right place to be a short-term trader. And if you're in the zone, time disappears.
that's the key. The antidote to FOMO isn't chasing harder. It's learning to ground yourself in the present. When you're truly in the moment, you don't feel the fear of missing out. You feel calm enough to wait for your edge. The last major bias we need to cover is loss aversion. Loss aversion is the tendency to fear losses more than we value gains. Studies show that losing $1 feels about twice as painful as winning $1 feels good. In trading, this bias can be deadly. It's the reason traders hold on to losing positions, telling themselves, "I'll sell when it gets back to my entry price." It's the reason they move stop losses further away instead of taking the hit. The brain desperately wants to avoid the pain of admitting a loss, even if that means making the loss much bigger. Think about it. How many times have you let a small red trade turn into a huge drawdown because you couldn't accept being wrong? That wasn't your system. That was loss aversion controlling your decisions. Mark Douglas explained that successful traders accept risk completely before entering a trade. They don't fight the possibility of loss because they know losses are part of the game. If you can't accept that, your emotions will eventually force you to break your rules. The market punishes denial, and the fastest way to protect your account is to learn to take small, planned losses without hesitation. And Phil Goedicke shows exactly how dangerous it becomes when we ignore that rule.
Stops are a must. I mean, we all have to use stops. Now, I personally rarely use hard stops, but I have mental stops on every position that I take. Basically, if something's breaking support or resistance, I usually just exit that trade. And I think most of us here need to have a mental idea in our head of where we're going to exit a trade, based on where it goes against us. How many of us here have ever been in a losing trade and we're down something small, maybe $5,000, and we think, I'm not going to cut it. I feel like this is going to be a winner, and we add to that trade. An hour later, we're down $20,000 to $30,000, and we think, wow, it's hard to, I can't cut it now. We hold it till the afternoon. Maybe tomorrow it gaps up. We're down $70,000, $80,000, $100,000, and we think, what the heck just happened? I could have cut that loss yesterday for $3, $4, $5 grand. Now I've given up 10, maybe 20% of my year just by being stubborn. Think about how much more money we could make at the end of the year if we just stick to some simple rules and cut our losses at an appropriate place.
That's the reality. Phil's story shows how loss aversion can take a small cut and turn it into a massive wound. The only way to protect yourself is to predefine your exit and have the discipline to respect it every single time. But loss aversion is only one of many traps. Confirmation bias, overconfidence, herd mentality, and FOMO all work the same way. They quietly hijack your decisions and make you believe you're being rational when you're not. So how do you fight back against these biases? The first step is awareness. You can't eliminate them, but you can learn to recognize when they show up. A few practical tools can help. Use a checklist before every trade and ask yourself, am I following my plan or am I acting on emotion? Write down both bullish and bearish scenarios before entering a trade. This forces your brain to consider evidence on both sides, not just the one that feels comfortable. And keep a trading journal that doesn't just track numbers, but also records what you are thinking and feeling. Over time, patterns will appear, and you'll start to see which bias is your personal trap. And here's your exercise for this week. Look back at 5 of your recent trades. For each one, ask yourself, which bias was present? Was it confirmation bias, overconfidence, herd mentality, FOMO, or loss aversion? Write down a short note about how it showed up. Once you identify your most common bias, you'll know exactly where to focus your discipline. Remember, every trader has these mental blind spots. The difference is that average traders are ruled by them, while professionals learn to recognize and manage them. The market will always tempt you to deceive yourself. But if you can step back, label the bias, and let logic take over, you move one step closer to consistency. And in the next module, we'll dive even deeper into one of the strongest forces in trading psychology: fear, loss aversion, and the paralysis problem. You'll see how fear not only makes you exit too early, but sometimes keeps you from taking trades at all. And more importantly, you'll learn how to break through that hesitation. So, trader, If this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.